Hello, this is Dr. Nunez. Welcome to the Chapter 20 problem solving session. So these are the exercises that we're going to be covering in Chapter 20, the basic exercises and the regular exercises. And we're going to get started with BE 20-2. It's a contribution margin based problem. So we need to determine first the contribution margin ratio, the unit contribution margin, and the operating income. Well, I really think it makes sense to start with the contribution margin, the unit contribution margin, and then we'll calculate the ratio. Okay, so let's see here. The price is P, and the price that we're given here is $185 per unit. And we are also given variable costs. So the variable cost, well, we're going to call that V. And the variable costs are $111 a unit. Right. So we're given the price, we're given the variable costs, and that's really what we need to determine the contribution margin. The contribution margin, the unit contribution margin, is you think of that as the CM, all right? Unit contribution margin is P minus V, right? It is the price minus the variable costs. So all we need to do is take the difference between those two because that's what the contribution margin is. It is the excess of the sales or the selling price over the variable costs. So if we take that 185 minus the 111, we end up with a unit contribution margin of $74. The unit contribution margin is $74. So that's B, a unit contribution margin of $74. And if we want that expressed as a ratio, right? A ratio. So let me go ahead and label this here as it's B, the unit contribution margin. But if we also need the contribution margin ratio, right? So let's call that contribution margin ratio. And I like to abbreviate that contribution margin ratio as the CM percentage, right? And all that is expressing the contribution margin as a percent of the price, expressing the unit contribution margin as a percent of the price. Or if we had total dollars, we could express total contribution margin as a percent of total sales. But we don't have the total sales or the total contribution margin. So we'll just use what we have, which are the unit costs, right? So we want that CM expressed as a percent of the price. It's just the CM divided by the price. So the CM in this case is that $74. And we want to divide that by the price, the 185. That's going to give us that contribution margin as a percent of sales, or the contribution margin ratio, which is 40%. So the contribution margin ratio, 40% of every sales dollar is contribution margin. Okay, so said another way, for every dollar in sales, you end up with 40 cents of contribution margin. And remember, the contribution margin is the contribution to the fixed costs and the profit. That's what we have. 40 cents on every sales dollar goes towards the fixed costs and the profit. And if we want to know the operating income, well, that's a different question. And if we want the operating income, that's going to take a little bit more manipulation here. Essentially, the operating income is, it's that income measure at the bottom of the income statement. So if we think of, let me see if I can somehow list all of this out. If we have the sales, right, minus the variable costs, that will give us what we call contribution margin. And then if we subtract those fixed costs, that will leave us with the operating income. Will leave us with that operating income. So that's all we need, all right? Sales minus the variable cost gives us the contribution margin, and subtract those fixed costs, and we've got operating income. So what are the sales? Well, the sales are selling price of every unit is $185, and they have 180,000 units that they sold. Sales is always going to be price times volume, right? It's always going to be the price times the volume. So we need that P, and we want to multiply times that volume, and that's going to give us the sales. So in this case, we have a selling price of $185, and they sold 180,000 units. And what that's going to give us is total sales of 33,300,000. That's our sales, right? Price times volume. P times the volume. $185 times 180,000 units is $33,300,000. And if we want the variable costs, well, the variable cost, that's just going to be V times the volume, right? And V times the volume, well, the variable costs are $111 a unit. So we're just going to multiply that times 180,000 units. And we'll end up with the variable costs, which are 19,980,000. And again, the contribution margin is the excess of the sales over the variable costs. And in the textbook, I think the authors actually show this as kind of a negative number. So I'll go ahead and do that so that you don't forget that it is subtracted from the sales, because it is the excess. So if we go ahead and show that in brackets, we know that we are subtracting those variable costs from the sales. The net result is we get a contribution margin of 13,320,000. $13,320,000 is the contribution margin, right? The sales minus the variable costs. And then we just want to subtract those fixed costs, right? The fixed costs are just given, right? The fixed costs are just $8,175,000. $8,175,000. So the $8,175,000, right? And again, those fixed costs we are subtracting. So, I'll use the author's convention and, show that in brackets so that we don't forget to subtract those costs from that contribution margin. So in effect, we've got operating income, right? The net result is our operating income, and the operating income is $5,145,000. $5,145,000. $5,145,000 is the operating income. Okay. So if we need operating income, we can set up a little income statement like this and calculate those key measures. So again, the sales, which is price times volume, minus the variable cost, which is the variable cost per unit times volume, right? Sales minus those variable costs gives us that contribution margin. And then we just want to subtract those fixed costs. And what we're left with is the operating income. And this is C. That's what they're looking for in C, that operating income. So we started out by finding the unit contribution margin, and then we found the contribution margin ratio, and then we determined the operating income with the basic income statement. And there are other ways to get to operating income. We could set up an algebraic equation, but it's a lot more straightforward. It's easier to follow if we set up a little income statement like this. Okay. So let's move on. Next, let's look at the break-even point. So one of the tools that we introduced in this chapter was that break-even point, right? Being able to determine the break-even point in sales units. And in this case, we've got a what-if scenario. What if the selling price increases to $80 per unit? So in basic exercise 20-3, we've got our price. And let me just go ahead and identify those here. So the product sells for $75 a unit. That's our P, right? Our selling price is $75 per unit. And the variable costs are $50 per unit. That's our V. And then we've got some fixed costs here, and I'll just label that as the F. Those are the fixed costs. So we've got all the information that we need in order to be able to establish what that break-even point is. And let me just put here as a reminder, the break-even sales units, and I'm going to abbreviate that, BE sales units, right? Break-even sales units is going to equal, all of the fixed costs. Take all those fixed costs in the numerator, and we just want to divide by that unit contribution margin, and that'll give us the break-even in sales units. So the fixed cost divided by the contribution margin. And let's see, the fixed costs, I already identified those. It's $5.4 million, right? So $5.4 million of fixed costs. And we want to divide by the unit contribution margin. And remember, P minus V is the unit contribution margin. So just a little note here that unit contribution margin is just P minus V, which for our purposes, let's see, we have a price of $75 and we have variable costs of $50. So P minus V, or the unit contribution margin, is exactly $25. So in this case, we want to make sure that we are dividing by the $25. So $5.4 million divided by $25 gives us the break-even in sales units, which is 216,000 units of product. When we sell exactly 216,000 units, we break even. There's no profit, there's no loss. The total revenue just equals the total cost. So that would be A, right? So A is the break-even in sales units. And now we have a what if scenario. So let's see, up here, let's make sure we identify this. Up here, the contribution margin, P minus V, is $25. But if the selling price increases to $80 per unit, well, now it's going to change a little bit, right? Now that contribution margin, which is still going to be P minus V, right? P minus V is now going to change a little bit because the price is now $80, right? And $80 minus that $50 contribution margin means we've got a contribution, $80 minus the $50 of variable cost now gives us a unit contribution margin of $30, right? So when we increase that price a little bit, the contribution margin goes up. Contribution margin has to change whenever you change price or variable costs. So now if we want to redo this calculation, right? So in B, we want to redo this so that we calculate a new break even. And again, the break even sales units is going to be those fixed costs, right? And the fixed costs are still 5,400,000. They're unchanged, right? We haven't changed those fixed costs. The 5,400,000 now, instead of dividing by 25, we want to divide by 30. So we have that new contribution margin, and we're going to have a new break-even point. And that new break-even point is 180,000 units of product. 180,000 units of product. So when our contribution margin goes up, we don't have to sell quite as many units, right? We can sell fewer units to break even because we have more contribution margin per unit of product. So that's, again, one of the tools that we introduced in cost, volume, profit analysis. But remember, sometimes firms don't want to just break even. Sometimes they want to be able to generate a profit. And that's what we see in BE 20-4, a target profit. So we have a firm here that wants to do more than break even. They want to generate a profit ultimately of $630,000. So the first thing we're going to do is figure out what that breaking point is, and then figure out what they need to do to generate a profit of 630,000. So we need to know here what that unit contribution margin is, right? So again, want to make sure we understand that we've got here a P, right? A price of $120, got a variable cost of $84, and the fixed costs are 1,890,000. So when we put all that together, remember the contribution margin, the unit contribution margin is going to equal P minus V, which in this case is that price of $120 minus the variable cost of $84, which just equals a unit contribution margin of $36. A unit contribution margin of $36. So the break-even point, right? If we focus on A, break-even sales units, the E sales units is again going to equal those fixed costs, right? Those fixed costs divided by the unit contribution margin. So the fixed cost, the 1,890,000, we want to divide by the $36 unit contribution margin. They need to sell exactly 52,500 units of product in order to break even. So they will break even when they sell 52,500 units of product. On the other hand, if they want to do more than break even, right? And they want to do more than just cover their costs, they want to generate a profit. Well, if that's the case, then we want to modify this equation, right? So sales units for a target profit. Well, so now we need, in this case, to be able to cover both the fixed costs plus the target profit. Right, so the numerator goes from just fixed costs, which is what we had in A, to fixed costs plus the target profit, and we want to divide by that unit contribution margin. Right, so now we're saying we have those fixed costs of 1,890,000, plus we want to be able to generate a target profit of 630,000, and we want to do all of this generating a unit contribution margin of $36 per unit. So we need to be able to sell 70,000 units of product. When we sell exactly 70,000 units of product, then we generate a profit of $630,000, right? We do more than break even, right? So we break even, we cover the 1,890,000 when we sell 52,500 units. But if we also want to be able to generate this profit of 630,000, well, we need to ramp our volume up to 70,000 units. Okay. So that's a break even in units and our target profit. So the sales units for a specified target profit. Now let's switch gears a little bit and go back and talk about cost behavior in exercise 20-6. So remember from the lecture, we've introduced two basic cost behavior patterns that allow us to easily predict our costs. Those two cost behavior patterns are fixed costs and variable costs. Now, if you put those two together, you have what's called a mixed cost. But essentially, there are two components in that mixed cost, variable costs and fixed costs. And the way these costs behave is that fixed costs are assumed to be constant in total across all levels of activity. And the variable costs are constant only on a per unit level. So we need to complete the schedule and identify each cost by the appropriate letter. So we're just going to complete the schedule. So what we are given is the total costs that are variable, 720,000, and the total costs that are fixed when we produce 40,000 units of product. Well, the first thing that we can do here, which is the easiest thing to do, is to project those fixed costs, because the fixed costs are constant in total across all levels of activity. So that means that we're going to have 600,000 across all levels of activity. It doesn't matter whether we produce 40,000 units, 80,000 units, or 120,000 units. The fixed costs are going to be 600,000 across all levels of activity because they're constant in total. That's a key assumption with fixed costs. That's what we can assume. So that's how we can predict those fixed costs. They're easy to predict because they're constant in total. And since we've predicted the fixed costs, well, what we can also do now is calculate the fixed costs on a per unit basis. Well, anytime we need a cost per unit, well, then all we're going to do is take the total cost here for the fixed and divide by the number of units, right? So if we take $600,000 and divide by 40,000 units, then that will give us the fixed costs on a per unit basis. So the fixed costs on a per unit basis are $15 here when we sell exactly when we produce and sell 40,000 units of product. And I'm going to go ahead and calculate all of them, and then I'll fill them all in above. So 600,000 is the fixed cost when we produce 80,000 units, right? So again, we can determine what that unit cost is. It's $7.50, right? So when we produce 40,000 units, it's $15 a unit. When we produce 80,000 units, it's $7.50 a unit. And then lastly, that $600,000 spread over 120,000 units of product means that the unit cost would go all the way down to $5. So the fixed costs on a per unit basis are $15, $7.50, and $5, right? So again, if we want a unit cost, all we have to do is take the total fixed cost divided by the number of units. Okay. So we have projected the fixed cost in total, 600,000, 600,000. We've calculated the fixed cost on a per unit basis by just dividing by the number of units. Now, we need variable costs. And what's true of variable costs is they are constant on a per unit basis. They're going to, in total, they're going to vary directly and proportionally with the activity, but on a per unit basis, the variable costs are going to be constant. So we've got variable costs of $720,000. And that is for exactly 40,000 units, right? So we've got total variable costs of $720,000, and that is for 40,000 units. So 720 divided by 40,000 units is exactly $18. The variable costs are $18 a unit. And what we know about variable costs is they are constant on a per unit basis. So if they're $18 here when we produce 40,000 units, they are also $18 when we produce 80,000 units. And when we produce 120,000 units, well, again, they are $18 because variable costs are constant on a per unit basis. So if they're 18 here, they're 18 here, and they're 18 here. So we've calculated all the per unit costs, and just use a little bit of math here, and we'll have a total cost. So 18 plus 15 is 33. And 18 plus 750 is 2550. And 18 plus 5 is 23. And we have finished the bottom portion of the schedule. So again, we can project the fixed costs in total, divide by volume, and we've got fixed costs per unit. We can calculate the variable cost per unit based on the 720, and then we can just project that because it's going to be constant. And now the last thing we need here is to complete the top part of the schedule. We need the variable costs in total. Variable costs in total. How do we get that? Well, they're $18 a unit. Variable costs are $18 a unit. So it's going to be $18 times, in this case, 80,000 units. $18 times 80,000 units will give us the variable cost in total at that activity level, 1,440,000. So when we produce exactly 80,000 units, the variable costs are $18 a unit. 18 times 80,000 is 1,440,000. And when we produce 120,000 units, well, the variable costs are still $18 a unit, but now it's times 120,000 units, which means the total variable cost goes to 2,160,000. So the variable costs in total here are the million or 40, and the variable costs here are 2,160,000. And again, just a little basic math to calculate total costs. 1,440,000 plus 600,000 is 2,040,000. And at 120,000 units is 2,760,000. So we've got everything we need on the schedule, and everything is based on those cost behavior patterns that we introduced in this chapter. Fixed costs are constant in total. Variable costs are constant per unit. And then based on that information, we can calculate unit costs. Just take whatever the total is, divide by the number of units. We can calculate a total cost. Just take the cost per unit, multiply times the volume. So it doesn't matter what this table looks like, whether it looks exactly like this or whether it looks a little different. Given those basic assumptions, we could easily complete a table like this with varying numbers. We could be given unit costs, and then we could project the total costs. In this case, we're given total costs, right? We could do this table under any circumstances because we understand those cost behavior patterns. So that's a little bit on cost behavior. And let's see, let's go back to our tools. Now, in the next exercise, exercise 20-11, we're back to break even and target profit. So we have some assumptions here. Let me identify what we are assuming. We've got some fixed costs, 34,200,000. We've got a variable cost of 930, and we've got a unit selling price of 1,500. So we've got F, we've got V, and we've got P. And we know that the contribution margin, right, that unit contribution margin is equal to P minus V, right? So we can get that unit contribution margin by taking the $1,500 minus the variable cost of 930, and that will give us a unit contribution margin of $570. A unit contribution margin of $570. And if we want the break even in unit sales, right? So the break even unit sales is just going to equal those fixed costs, right? Divided by that unit contribution margin. So we're going to take those fixed costs of 34.2 million, and we want to divide by that unit contribution margin of 570. They need to sell 60,000 units of product. When they sell exactly 60,000 units, they break even. But again, some companies don't want to break even. They want to go beyond break even. They want to generate a target profit. So sales units or target profit. So modify that break even calculation, right? And now we want those fixed costs plus the target profit. And we want to divide by that unit contribution margin again. So in this case, what we have here is the fixed costs again of 34,200,000, and we want to add in that target profit of 5.7 million. And we're just going to divide by the unit contribution margin of 570. So if they want to be able to generate that profit, the number of units that they need to be able to sell, right? The number of units that need to be sold is going to be 70,000. Right? If they sell exactly 70,000 units, they'll generate a profit of $5.7 million. So kind of like one of the earlier ones that we did. Now we've got a couple more left. So actually we've got one left, exercise 20-13. So let's finish that one off. another break-even one, and then with a what if scenario in part B. So what we have in part A is a selling price or a P of $1,000, a variable cost of $600, and some fixed costs that total $21,600,000. And they've got this proposal that we're going to look at in part B, where the price will change. So we'll talk about that when we get to B. But let's focus now first on A, the current break even. So we do need to know what that unit contribution margin is, right? And the unit contribution margin, again, is just the P minus that V. And again, price is $1,000. And those variable costs are 600. So we're looking at a unit contribution margin of 400. And if we want to calculate the break even here, so the break even sales units is again just going to be those fixed costs. And I'm just going to go ahead and fill in the fixed costs of 21,600,000. And we want to divide by that unit contribution margin of 400. So we get break even in sales units of 54,000 units. We need to be able to sell 54,000 units of product in order to be able to break even, to reach the point where our total revenue just equals our total costs. Now, on the other hand, if we're looking at a proposal to increase the unit selling price, well, then what's going to be the new break-even point? How's that break-even point going to change? Well, so the first thing we need to be able to do is recognize again that we've got a new P, right? So the new P, this new P is going to be 1,200. And if that's the case, then that new contribution margin, right? The new unit contribution margin is going to again equal P minus V, which now goes to $1,000 in selling price. That doesn't change, right? But no, I'm sorry. The selling price does change. It changes to 1,200. The variable costs do not change. The variable costs are still $600. And if that's the case, then we're now looking at a unit contribution margin that goes up to 600, right? If we sell the units at a higher price, then we're going to have more contribution margin now. And the break even in sales units is again going to equal 21,600,000. And we want to divide by that new contribution margin, that new unit contribution margin. So now what's going to happen is break even is going to go down, right? You don't need to sell as many units because you're getting more contribution margin per unit. In fact, you only need to sell 36,000 units of product if your contribution margin goes up to 600. So that's exercise 2013, and that actually is the last one that I assigned. So hopefully this session has been helpful and you'll be able to complete your application assignment and your quiz for chapter 20. Take care, and I'll see you in the next chapter.